Fine guys, we'll revise now chapter 7, which talks about overview of customs law. Customs law or customs duty is a part of indirect taxes. Whenever there is an import or export of any goods, the customs duty would be levied. That is on import duty, and on the export duty. Both is covered under the customs law, which is purely the revenue of central government. And the central government will be governing all this through Customs Act 1962, which is passed by central government. So whenever any person is coming into India or going out of India, or goods is coming into India or going outside India, or whenever there is any smuggling and all these things are taken care or governed under the Customs Act 1962. Then there are two things, rules and regulations, which will support the act. Rules is given in section 156, which the power to make rules is given with central government, whereas the power to make regulations is with CBIC, that is Central Board of Indirect Taxes and Customs, and it is given under section 157. Rules as should always be consistent with the provisions of the customs law, whereas the regulations should be consistent with both the act, the provisions of the act, as well as the rules. Then coming to levy of customs duty, section 12 of Customs Act 1962 is the charging section, where they tell the customs duty would be levied whenever the goods is imported into or exported out of India, as per the transaction value, which is determined under section 14. So the rate of duties are given in Customs Tariff Act 1975. There are two schedules there. Schedule 1 will tell the import tariff rate for the imported goods, whereas the schedule 2 will tell export tariff rates or export duty rates for the exported goods. Then coming to different types of duties which are levied under the Customs Act are one by one. Basic customs duty will always be levied whenever the goods are imported into India, and the transaction value, which is calculated, or assessable value, which is calculated under section 14, and it will be levied at normally standard rate or preferential rate. That is only when the goods are imported from any preferential area, which with the government of India has an agreement. Then social welfare surcharge also will always be levied, that is at 10% of basic customs duty on all the goods imported into India. Then IGST will always be levied. So wherever I have mentioned in always, that is irrespective of whether it is separately given in the question or not, you have to calculate it. IGST, the goods imported into India are now subject to IGST and not CVD or SAD. But if there is any goods on which GST is not applicable in India, if you are importing that like alcohol or petroleum products, then on the import of that, in addition to basic customs duty, now even CVD and SAD would be levied. Whereas in any other case, in addition to basic customs duty and social welfare surcharge, IGST would be levied for all imported goods on which GST is applicable in India. Then coming to GST compensation cess, it can be levied only on the import of goods. If the same goods is sold in India, if cess is levied, that is either luxury goods or sin goods, then if you are importing that same luxury goods or sin goods, in addition to all whatever we have discussed, even compensation cess will be levied. Then coming to protective duty, in order to protect the Indian domestic industry established in India, a duty may be imposed on imported goods on the recommendation of Tariff Commission. Then coming to anti-dumping duty, if India is used as a dumping ad to sell the goods at a lower price when compared to the same goods are sold in the foreign country at a higher price, in that case, for that goods to inflate the price of that goods in India, the government can levy anti-dumping duty. But the amount of anti-dumping duty can never be more than margin of dumping. Margin of dumping means the difference between the actual selling price in the foreign country and the selling price in India. Then coming to safeguard duty. Safeguard duty can be levied by the central government in order to safeguard the domestic industry. Why? Because if any goods is imported into India and sold here at a lower price, but the same goods is manufactured in India, but the manufacturing cost is higher than that. In that case, to safeguard our players, the government can levy safeguard duty. Then coming to road and infrastructure cess on imported goods, that is only on petrol and diesel, it will be levied at 8 rupees per litre whenever petrol or diesel is imported. That is, this is in addition to basic customs duty plus CVD and SAD, that will be there. In addition to that, this cess. Then introduction of else cess at 5%, it will be levied on assessable value whenever there is an import of any medical equipment classified in 4th schedule, and we cannot claim any input tax credit of the same. But on the import of medical equipment, if the duty is exempt, then even the cess will not be levied. Then coming to valuation for customs duty, on what amount the customs duty would be levied is called as transaction value or assessable value, which is nothing but the price charged between the seller and buyer. In case of transaction between the related party, price should be at arm's length price. If not, the value will be determined as per the valuation rules. So valuation rules are there. This is not the rules which we will discuss later. They are the rules where if you cannot determine the assessable value or transaction value as per section 14, then we will determine as per the rules. Okay. Now, so duty will always be levied on the assessable value or transaction value as per section 14. So for exports, the assessable value means the value of the goods at the time and place of exportation, which is nothing but FOB value. That is the value of the goods when it is leaving India. Then coming to imports, the price paid or payable at the time of and place of importation, which is nothing but CIF value. That is cost including insurance and freight. Value of imported goods shall be the transaction value. That is nothing but CIF is equal to FOB. That is the value of the goods when it was leaving foreign country. Plus whatever is the cost of transportation and insurance during transit. Then price referred above, if it is in foreign currency, definitely it will be. If it is in foreign currency, then we will convert it into Indian rupees by applying the rate of exchange as notified by or determined by CBIC as on the date of. If it is in case of import, the rate of exchange as on the date of presentation of bill of entry will be considered. If it is an export, then the rate of exchange as on the date of presentation of shipping bill or bill of export will be considered to convert the consideration from foreign currency into Indian rupees. Then if you cannot determine the value of supply, or here we will call it as transaction value or assessable value as per section 14, then we will apply the rule in the following sequence. In the same sequence, we have to apply it. First one is identical goods or comparison method. If you can find out the identical goods which is same as whatever you have imported with respect to everything, it is same to same, copy paste. In that case, transaction value of that identical goods will be used in determining the imported value of imported goods only when such identical goods are sold at the same commercial level, that is at the same quantity. Okay. If more than one transaction value is available, then take whichever is lower. Then coming to transaction value of the goods exported would be based on transaction value of goods of like kind and quality. Means there is a difference between identical and like kind and quality. Means there can be small changes where we consider it as like kind and quality or similar goods at or about the same time and from the same destination country. If same destination country is not available, you can take the other destination country. Then if rule 4 is not possible, then we will go to rule 5, where we will take similar goods and not identical goods. Similar goods are like almost same but not exactly the same. There is some differences. The transaction value of imported goods would be based on the similar goods like characteristics and country of production. Whereas in case of goods exported, we will take the computed value, which is nothing but it is produced in India. So take cost of production plus any other cost you have incurred plus what is the profit I am willing to make as an exporter. So that is nothing but my selling price. We will take that. Residual method, rule 6. This is applicable only for exported goods. The transaction value would be arrived at by reasonable and consistent means, which will be decided by the customs officer. Whereas rule 6 is not applicable for import goods. Rule 7 and 8 is applicable for the imported goods only. Here we will take the selling price at which or unit price at which the imported goods, or if that is not available, identical or similar goods are sold at the highest quantity. From that we will deduct all the expenses incurred in India and profit to be made by the importer. We will get, this is just a reverse calculation, we will get what was the value of the goods at the time of import. Then coming to computed value, which is rule 8. This would be the cost of material used in producing the imported goods. Means it is not manufactured here, but if the same goods are manufactured here, what is the cost of the raw material used in the manufacture of that goods? Including fabrication cost as well as profits will be considered. And including rule 10 items, that is freight and insurance. Whatever value we get, that will be the transaction value to levy import duty. And we have to follow these rules in the sequence only. Then coming to the calculation part, which you have to strictly stick to the format. Wherever in my revision material I have given the format in this color, guys, you have to stick to the same format. We cannot interchange the position. Yeah. Valuation terminologies, FOB value. This is important in case of export of goods. This is the value of the goods at the time of exportation when the goods are exported out of India. On this value, the export duty would be levied on the exporter. Whereas when it comes to import, CIF, which includes insurance and freight cost. This was the value of the goods when it is coming to India, on which import duty would be levied. The calculation part only is covered for you is import duty calculation. So first, export X factory price we will take it. That is the price of the goods at the seller's factory. When the goods are living in the seller's factory in the foreign country, what was the value of the goods? Then the seller would have incurred some expenses in that country to bring the goods from his factory to the port. We will add it. Then we get FOB value. For that, if importer has incurred any expenses in India, but buying commission should not be added. If importer has incurred any buying commission, we will not add it. If there is any other expenses, we will add it. Then we get something called as customs FOB. For that, there are two important adjustments as per rule 10, sub rule 2, which is freight expenses and insurance expenses, which I have given it here. If the cost of freight in case of imports, if the mode of transportation is by air, if actual freight charges is known, still we will compare it with 20% of FOB value. Whichever is lower is added. And if the mode of transportation is by any mode other than air, then whatever is the actual freight charges, we will add it. But if we don't know the actual freight charges, then we will always take 20% of FOB value. Then coming to cost of insurance. If it is known, take whatever is the actual cost of insurance which you have paid on the goods when you have taken it, when it was in transit. If it is not known, we have to take 1.125% of the FOB value. That is customs FOB value. Then coming back, once we do all this, we get the assessable value or transaction value, or we call it as CIF for the import purpose. This is the value on which import duties would be levied. So the second part is calculation of duties. So whatever we have got here, we will take it as a starting point for duty calculation. On that, basic customs duty will always be calculated. If the respective rate is given, please take it. If not, always apply 10%. Then safeguard duty, if it is given, calculate it at whatever rate they have given. Social welfare surcharge will always be there, but that is on basic customs duty. Okay, at 10%. Then you will get something called as landed cost of import after adding all this. Then on that, if there is any anti-dumping duty, if it is given in the question, we will add it. Then once we add that, we will get value for the purpose of leaving IGST. On that value, that is this value, at whatever rate IGST is given, we will add it. If rate is not given, apply it at 18%. Then GST compensation says if it is only given, we will take it at the respective rate. Once we add everything, we get what is the total cost of imported goods into India. If they have asked this, answer. If not, if they have asked you what is the total tax or duties payable in India, then add up all the taxes, whatever we have calculated here, that will be your answer. And whatever I have highlighted here in purple color is a mandatory thing. Even though question is silent, you have to still provide it. Yeah. Then coming to relevant date for the purpose of rate of duty. Rate of exchange we have discussed. If by chance, if there is any change in the import duty in the respective dates, then on what rate should we take? On what date? As this is for imported goods, section 15. 15(1)(a), where the goods are cleared for the home consumption. Immediately after the goods are imported and unloaded here, that is importer has paid the duty and it is cleared for home consumption. In that case, whatever is the import duty rate prevailing on the date of presentation of bill of entry or the date of entry inwards of the respective mode of transportation, whichever is later. Then coming to what if the goods are imported, stored in the warehouse, and then it is cleared for home consumption after the importer has paid the duty. Then the rate of duty has to be taken as on the date of presentation of bill of entry. In any other case, the rate prevailing on the date of payment of duty, guys. Next, relevant date for the rate of duty on exported goods, that is given in section 16. Only one option, that is the export duty rate should be taken as on the date on which the proper officer has made an order permitting the clearance and loading of goods into the conveyance. Then this rules or this sections is not applicable in case of baggage and goods imported or exported by post. Then central government has the power to exempt any goods on which import duty can be exempted or export duty can be exempted by way of notification. But they can also exempt through way of special order only under exceptional circumstances. If the amount of duty is less than or equal to 100, then they will not charge any duty to the importer or exporter. But if there is any withdrawal of exemption, government can do it only from the prospective date and not from the retrospective date. Then coming to powers of the customs officer. Under GST, the customs officer have the following power: declare warehousing stations where it has to be set up, then allowing setup of warehouse whether it is public or private, that means they will give the license. Power to search any vessel, conveyance or person in that, or power to seize any goods in the vessel or conveyance. Then power to arrest any person if there is any illegal activities conducted. Then transit and transshipment. Transit. See, whenever the goods is coming into India in a ship, in the Indian port, it is just halted and it will continue to a foreign destination. In that case, we call it as transit in India, and in that case, no duty would be levied. Whereas the goods is coming into India in one ship, in India, in a particular port, the goods are loaded from one ship to another ship. There is an exchange of ship, and the ship for which the goods are now loaded will continue to the journey where the destination port is outside India. In both these cases, the duty need not be paid because it is not actually the import into India. So there is a difference that is called transshipment. So transit and transshipment, there is a difference between both. In case of transit, goods remains in the same vessel at the intermediate port, and intermediate port will be an Indian port. Then, or we call it as a halting port. Then coming to transshipment, goods are transferred from one vessel to another vessel at an intermediate port, which is an Indian port. Okay. Will be duty levied there? No. Only import manifest has to be submitted for the entry by the person in charge in case of transit, whereas in case of transshipment, along with the import manifest, they should also file bill of transshipment or declaration is also required in addition to import manifest. Then in case of transit, no supervision is required by the customs officer, whereas in case of transshipment, the customs officer has to ensure that whatever goods are unloaded from ship 1 is actually loaded into ship 2. They have to just cross check the quantity. Then coming to transit, the same vessel reaches the destination port. Then in case of transshipment, the different vessel reaches the destination port. That means there are two ships involved here. Then coming to baggage rules. So as per baggage rules, baggage means whatever I am carrying along with me. It also includes unaccompanied baggage, but it will not include the car, that is motor car, alcoholic drink up to certain limit. It is allowed, but not that more than that. Then goods imported through courier. Then baggage rules 2016 provide for any duty-free clearance up to a certain limit. Means without paying tax, I can bring them into India up to certain limit. What are those? One by one. Rule 3 will tell any person who is coming to India, who is an Indian resident or a foreign resident but residing in India, or a tourist of Indian origin. If they are coming to India from any country other than Nepal, Bhutan or Myanmar, then they can bring the goods whose value is up to 50,000 without paying any duty. Then proviso to rule 3 is telling tourist of foreign origin, if they are coming from any country other than the same 3 country, then the value is up to 15,000 they can bring without paying any duty. Then coming to rule 4, an Indian resident or a foreign residing in India or any tourist who is coming from Nepal, Bhutan or Myanmar to India, they can bring any goods whose value is up to 15,000 without paying any duty. Then coming to rule 5, which talks only about the jewelry. Any passenger residing abroad for more than 1 year, if they are coming from any country into India, if he is a gentleman, he can bring 20 grams with a value cap of maximum 50,000, or if he is a lady, she can bring 40 grams of gold with a maximum cap of 1 lakh rupees, guys. Then coming to duty drawback. Duty drawback is given under 2 sections under the customs, 74 and 75. 74 talks about the goods which is imported, on which import duty is paid, and the same goods as it is exported back. When the goods are exported, I can claim the duty drawback of whatever import duty I have paid when I have imported the goods. Same way section 75 is talking, if I import a raw material on which I have paid import duty, and the same raw material I am using it to manufacture my output, and my output is exported. Once I have exported my output, whatever import duty I have paid on the import of my raw material, I can claim it as duty drawback. Yes, there are some important differences between the both. 74, refund of the import duty paid on the import of goods when the same goods are re-exported as it is. Coming to 75, it is refund of import duty paid on the import of raw materials or inputs which is used in the manufacture of my output, which will be exported. Then 74, all goods are eligible for drawback, that is duty drawback, subject to their identification. Whereas in case of section 75, only notified goods can enjoy the duty drawback. Then coming to 74, duty drawback shall be allowed even if imported goods are used in India, but the duty drawback will be reduced to certain extent based on how long I have used it in India. But in case of raw material, I have imported it, I have produced the output, and if the output is used in India even for a single day, then you cannot claim duty drawback with respect to that goods. Then coming to, if the goods which I have imported, if it is exported as it is without use in India, then whatever import duty I have paid, 98% of that I can claim it as duty drawback. Then if I have used it in India after importing it, then based on how long I have used, the duty drawback would be reduced. Then coming to section 75, duty drawback can be claimed as per all industry rate, which is notified by drawback directorate, or if that is not notified, then I can apply for brand rate, and I can claim the duty drawback only if I am exporting the goods within 18 months. Then no duty drawback shall be admissible where the duty drawback amount is less than 50 in any of this case, guys. Not if all conditions are satisfied. In any of this case, duty drawback will not be given. If the amount of duty drawback is less than 50, the duty drawback amount exceeds 1/3 of the market price of export product. The duty drawback amount is less than 1% of the FOB value, but if the amount is per shipment more than 500, then I can claim duty drawback. Then where the value of export goods is less than the value of imported material, then also you cannot claim duty drawback. Application for duty drawback is required to be made within 3 months from the date of export of goods, which can be extended up to 12 months. And once I have made application, the duty drawback needs to be paid or processed within 1 month. And if it is not paid after the expiry of 1 month, even interest will start getting accrued for the customs department. Where duty drawback has been paid in excess to the person, then the excess amount he has to give it back. If he doesn't give it back within 2 months, then interest will be starting from the date on which he has received the duty drawback. Then coming to refund, duty drawback is different, refund is different under customs. Refund is first, both can be claimed as refund, that is either import duty or export duty. Refund of export duty. When the exporter exported the goods and paid export duty, and whatever goods he has exported is getting back. He is getting it back. There is nothing but sales returns in that case. And if it is got back, means if he has imported it back within 1 year from the date of exportation, he can claim the refund of whatever export duty he has already paid. But the application for refund has to be made within 6 months from the date on which the proper officer has made an order for the clearance of the goods which is imported back. Then coming to refund of import duty, I have already imported the goods, I have paid import duty. Now I am not satisfied with the goods which the seller has sent to me. I am sending it back, or I am destroying it in front of the proper officer, or I am relinquishing my right. I am giving it to the proper officer and I am going it. In that case, whatever import duty I have already paid, I can claim the refund of the same, but the application has to be made within 6 months. This is all about the revision. All the best, guys.